Defensive investing in a raging bull market. I'm here with Spuds Powell of Kane, Anderson, Rudnick in Los Angeles, a Barron's ranked advisor, and we're here to talk about this defensive investing. How are you, Spuds?
I'm doing great, Matt. Thank you.
Could you tell us a little bit? Your firm is about asset protection, and in the current market, I would imagine you get a little pushback from clients about defensive posturing. Can you tell us a little bit about how you handle that and what your approach is?
Sure, I'm happy to. It's a challenge. Our firm's first priority and our greatest strength is our ability to play great defense during a difficult market, and our clients know that that is our focus and forte. And at a time like this where the equity markets have performed so well now for the last 5 years, a lot of folks are starting to make the mistake of losing sight of the importance for risk management. And that combined with the fact that some of the more traditional defensive asset classes, such as bonds and gold, have not performed all that well of late, has caused a lot of today's investors to want to drift into higher risk portfolios. And so our challenge is reminding folks that one of the very few guarantees in our profession is there will be another recession and there will be another bear market. And it's important to help our clients recognize that and not make the mistake of chasing performance and assuming too much risk.
What does a typical asset allocation look like for a client, for a defensive client right now?
We will allocate a portion of our clients' wealth to high-quality, short-duration fixed income. When appropriate, we focus on tax-free municipal bonds. Within the equity markets, we focus on companies that have proven to do well during recessionary environments. We've always focused on equities from companies that generate significant profits, have low levels of debt, generate a significant amount of cash flow, and we place a premium on companies that pay large dividends because it's those types of companies that tend to play better defense when times get tough. And then we're also quite focused on allocating a portion of our clients' wealth to one or more alternative investment strategies. As an example, we're big fans of master limited partnerships. MLPs pay a very significant dividend, typically north of 6%, and have proven to do quite well more often than not during periods when equities struggle.
Are there any particular asset classes or sectors that you're favoring right now?
There are. One in particular that we feel bullish about these days is the energy sector. We all now know that our country is sitting on a massive amount of energy. There's a lot of buzz over becoming energy independent and being a net exporter of natural gas in particular. And as such, we are bullish about the outlook for MLPs. MLPs are publicly traded companies that own and operate the pipelines that are used to transport oil and natural gas throughout the country. And given our expectation that we're in the early stages of a massive amount of energy infrastructure development in America, the outlook for that sector looks quite promising. From an investment point of view, it's an appealing asset class for several reasons. As I mentioned earlier, these pipeline companies tend to pay a very large distribution. We live at a time where a lot of folks are retiring and looking for higher yielding asset classes. It's an asset class that offers a nice complement of both income and growth. And for folks who want to be more defensive and want to allocate a portion of their portfolio to things that can perform well when equities struggle, these pipeline companies have a proven track record of doing well more often than not during down equity markets.
Terrific. Thank you, Spuds.
You're welcome, Matt. It's a pleasure.